The way ahead, what does that mean in terms of economics context?
I think this year is going to be the year of rebound and recovery after all that, COVID and property downturn and regulatory tightening and so on. So this year is really, from a policy point of view, but also from the economic development point of view, it's recovery of growth.
4.9% was when we last spoke, was your forecast, I think. Is that still the forecast now?
Yes, we are at 4.9. Basically, we're saying around 5%, but above 5, I think, takes quite a bit of effort, maybe quite challenging, given that property is still at the bottom, and we haven't see it bottoming yet, and also that the global economy is slowing down, so exports is going to be a drag rather than a contribution compared to 2021. So there's some challenge there.
Then that leaves consumption as the only card they can play. What do you think consumption is going to look like this year?
Yeah, consumption is going to be the leading driving force of that recovery. And so the main thing is that during COVID, right, so there has been a lot of pent-up saving because people were locked down at home, and also there is a confidence issue, so excess saving went up. Even some consumer activities cannot take place because of offline closures. I think this year, with the exit from the zero COVID policy, a lot of that is going to resume. So we see real consumption growth at more than 6.5% this year, and retail sales probably going to be close to 10%.
A lot of that also comes down to confidence, and that comes down in part to property. What do you make so far of this whole list of measures they've announced so far, and do you think we'll get more? Do we need to get more?
On the property side, I think in mid-November, when the government announced these 16 measures of support, financing support for developers, I think that marks a turning point in the attitudes towards the sector. And right now, I think de-risk for the sector, instead of being deleveraging, right now is how do we stabilize, how do we support the sector so they can grow, they can develop more healthily, right? So since then, there has been one after another, more detailed measure following in. So if it's not enough, I'm sure there will be more. I think there will be more. So one area we think that could come is more funding support for the stalled projects, from policy banks and commercial banks, but also for the home buyers. The recent announcement about the so-called mortgage rate adjustment mechanism, I think it's going to end up lowering mortgage rate, and we expect more cities probably ease the purchase restrictions. And then combined with the exit from zero COVID, I think that's going to stabilize the property sector. We see sequential growth from March, April onwards.
So the loan prime rate, do you think that's going to go down this year further?
Yes, we think the loan prime rate has some room to go down.
Will inflation be a problem?
Inflation, we don't think it's going to be a problem, but we do see CPI inflation going up because, prices of airline tickets and transport, hotels, food and beverage, were weak, and they need to recover, and they are recovering. They're going to recover more, so that's going to push up prices. But on the other hand, property is still relatively weak, even after the rebound. So the upstream materials and input costs are going to be low, and global energy prices are also relatively subdued. So PPI is not going to put too much cost pressure. So we are looking at inflation at around 3%.
And for investors looking to places, for example, just top of my head, like Australia, for example, to play the reopening, in terms of imports of raw materials and commodities, what do you think China's going to need, this type of recovery specifically? Well,
this type of recovery, I think a big thing is domestic driven, but a lot of transport and resumption of tourism driven. So I think demand for liquid fuel, like for oil, is going to go up. That's quite obvious. And then the stabilization of the property sector probably will put a floor on some of these commodity prices. I mean, iron ore price have already rebounded, and then you also have the government's focus on new energy, renewable energy, new energy vehicles. So things like copper would benefit from both that structural demand and also the rebound in property.
Now, looking at the reopening story in China, the last one really in the world to open up, right? I look at the US, for example, and we've had issues of inflation and labor market tightness there. Do you think we'll get some sort of unexpected phenomenon in China's labor market, similar to what we saw in other places?
I think it's going to be much less because I think in China, unlike in U.S. and many European countries, there's no direct income subsidy. There's no check in the mail, so people have to work. They cannot afford to say, I'm too worried about, COVID situation. And also, to a great extent, COVID happened, sort of swept through China very quickly. So a lot of people already got it and recovered. So I think both of these issues combined, plus the economy is very weak. There's a lot of slack in the market. So we don't think there's going to be, a big issue on the labor market. Of course, there could be around Chinese New Year, there could be some, disruptions. People decide to take longer holidays and stay at home, should take care of themselves or their family. So there could be a bit, but I think in general, it's not going to be a major issue. And
the biggest risk very quickly to China is internal or external this year?
I would say it's a bit both, but maybe still internal because the uncertainty about the COVID situation is high. Nobody can really predict, and also confidence about the property market, right? So we have certain baseline, but will people be really optimistic or they're pessimistic? It's unclear. Globally, I think, of course, we worry about excessive rate hike by the Fed that could lead to a deeper recession. That means very weak export.